Hello and welcome to this special show where we celebrate the 25 years of Nifty on the 25th of every month on CNBC TV 18. Almost a month into 2019 and we seem to be carrying the volatility and uncertainty of 2018 deeper into this year. There have been various factors like high crude oil prices, interest rates, rupee, banking liquidity, FIS selling and credit events to digest in the previous year. The good is that the crude oil prices are off 2018 highs of $80 a barrel and the other factors seem to be stabilizing as well. But this is an election year and some populist measures not ruled out. And then of course it's the earnings season going in which the markets are factoring in right now. Plenty to talk, but how should you be creating prosperity? To get that help, we have with us now Nilesh Shah, Managing Director of Kotak Mutual Funds. Nilesh, hi, thank you so much for joining us. First of all, since you are most of the earnings season really is done, what has been your sense on that? Have the companies made profits, revenues? Have the investors really made profit in that sense?
So December 18 quarter has been tough. The top lines have come through, but the margins have been under pressure. This is primarily driven by the fact that throughout September 18 and October 18, liquidity was very tight. Consequently, short-term interest rates went up. Then there was problem in transmission of credit as PCA banks were not lending and NBFCs themselves came under pressure. So combination of tight liquidity, high interest rates and lack of appropriate transmission kind of impacted December 18 quarter. We could see good turnover growth, but the margins remained subdued and hence the profitability growth came little below market's expectation.
So would you say much of the pain is now in the numbers, or are you looking at the next couple of quarters going the same way?
Fortunately, there has been a lot of action taken by RBI in terms of providing liquidity. A lot of action taken by the government and RBI in terms of settling down NBFCs. So our feeling is that Jan to March 2019 quarter one should witness better economic activity as liquidity pressure eases and short-term borrowing gets rolled over. However, there are two concerns which market is facing at current level. One, on 1st February, what kind of fiscal prudence is shown by the government. Finance Minister has been assuring market that the fiscal discipline will be maintained. And the second thing will be in May 2019, what kind of government we get post-general election. So fiscal prudence and the government formation are two concerns which will keep market probably under control.
Nilesh, that point is well taken. Well, yes, Feb and May are going to be important months in 2019. But if somebody was investing today, would you say that the investment decisions would change a lot on the 1st of Feb or in the month of May? Or would you say that the longer-term policies would be in play? Or are you suggesting that the populist measures that we might see on 1st of Feb and then, of course, in the month of August, this is a year we will see two budgets, would that change the investment decisions by a lot?
Essentially, if we see on the day of election results, there is sharp volatility caused by the results. In 2004, we saw market coming down dramatically as they got a government which was against their expectation. In 2009, we saw markets jumping up 20% when again they got a surprise result. However, over the tenure of the government, it is their economic policies which matter and not what kind of results we got. So in 2004, despite sharp correction, we witnessed biggest rally from 2004 to 2008. In 2009, despite 20% jump on the election result day, from 2009 to 2013, returns were very subdued. So if you are looking at from a very short-term point of view, results, budget, they could create material impact on a particular day. But over a long term, these events will lose their relevance. And what policies we pursue, that will have material impact. So anyone who is investing today, if he has ability to ignore short-term fluctuation caused by budget or election result, yes, this is right time to invest.
Nilesh, also when we talk about the Indian markets, it really is about the liquidity. We have seen a lot of concerns on that in the global markets as well, the way the prices have been moving. But talking about the domestic markets first, what is your sense on the liquidity right now? We do see, if you look at the investment numbers on month on month, even quarter on quarter, have seen an uprise here. Also, when it comes to investing, I know it's a mix really, but what is the kind of investment advice that you would give right now? Is it going to emerge from the mid caps, large caps, and sometimes, of course, people have seen volume or rather value in small caps as well?
So if we are taking a longer term view, then today small caps are available at marginal discount to their 10-year average. Large caps are available at marginal premium to the 10-year average. So effectively, whether it's large, mid or small, all three are available near their 10-year historical average. We are advising investors to follow asset allocation and also play contra. For example, if market is pricing in a stable government, then it is likely to be little higher from current level. In that kind of scenario, you may want to protect your portfolio by taking a defensive approach, which is more investment in large cap stocks, more investments in defensive stocks like IT, pharma and FMCG. Because in case market indeed gets a stable government as priced in, then high beta stocks will go up, but defensive portfolio also will fall, will also move in tandem. On the other hand, if there is a shock to the market in terms of election result, then this defensive portfolio will outperform big time. On the other hand, if market is pricing in a coalition government, then it is likely to be lower from current level. That's the time when you take risk by investing into capital goods sector, by investing into small cap sector, by investing into high beta sector, because in case there is a surprise and voters vote for a stable government, that portfolio will outperform big time. So looking at near short term, one can take tactical call in terms of going into defensive stock or going into high beta small cap stocks. But if you are a long term investor and you can take this kind of events into your stride, then my feeling is that you should create a balanced portfolio of, let's say, multi-cap, some large caps, some small cap, and over a period of time that portfolio should be able to outperform the market.
Neeraj, that's a lot of sound advice, of course, coming from you. A lot, as you said, depends on what kind of government are we going to see finally at the center there. But this is about the domestic factors, and we seem to be, or we have been reacting to the global factors quite a bit as well, with the kind of uncertainties that we see coming in from the European Union, from Brexit, from US, the China slowdown, and of course the overall global growth concerns, not just for this year, but a downgrade for the next year as well. How are you factoring that into the Indian markets?
So Brexit for us is more emotional rather than fundamental. Somewhere UK was our colonial master, and that's why we are more emotionally engaged with them. I doubt if Brexit will have any impact on Indian economy or Indian market. Of course, global factors do matter, and slowing down of global growth is a concern for our market. However, we have to realize that if global growth is expanding at a rapid pace, then our growth rate of 7.5–8% to that extent doesn't look very attractive. But when global growth is subdued, then our growth rate of 7.5–8% will look fairly attractive, and that should help us attract capital flows. More importantly, if we see on a longer term basis, the tariff war between US and China creates an opportunity for India, provided we act upon it and capture. Many manufacturers are moving away from China so that they don't get caught into this tariff war between US and China. Now, as per Economist article some time back, footwears are going to Cambodia, food processing is going to Vietnam, computers are going to Taiwan, electronics is going to Thailand and Malaysia, clothing is going to Bangladesh. There's little being talked about what is coming into India, and this is the greatest opportunity for us. The two of the largest buyers of Chinese goods in US are Amazon and Walmart. Both of them are present in India. We need to attract those manufacturing companies, those manufacturing bases from China into India and start exporting out of India. This is like Y2K opportunity for Indian IT sector. Y2K looked very laborious work, very unattractive work, but on that work we created foundation of Indian IT industry. By making food processing, clothing, footwear, we'll be able to develop India's manufacturing base, and that's a great opportunity in the global context.
Nilesh, one final question before we let you go. And while, of course, you did mention on what sectors to watch out for, you've given us case studies as well on how the investment should be going forward. But when it comes to asset allocation, and as you pointed out that it is about equities, I also want to know how much would you really give to real estate? Does it continue to be the silent area right now? Because for some time, we haven't heard too much on that one. And then, of course, gold and debt. How are you putting in the right mix when you look at all of these?
On the fixed income side, our recommendation is to take a little bit of duration play, as we believe over longer term interest rates could come down. And a beginning could be made post-budget if fiscal prudence is maintained in the monetary policy immediately after the budget. And that will be well for the fixed income duration fund. For investors who are looking at stable income, they can also look at credit risk fund. Due to IL&FS default, credit spreads have widened, and hence credit risk funds have become attractive from an investment point of view. And because of the diversified nature and structuring, we don't see another event like IL&FS impacting those portfolios in the near term. The second thing related to gold, normally we have seen that gold hasn't done well when US interest rates are rising. Now already US Fed future very faintly, not confirmation but very faintly, is indicating about a potential rate cut in 2019. Now in a scenario where US interest rates are declining, gold starts doing well. We also have election uncertainty in May 2019, and any shocker result will also have an impact on rupee. So putting those two things together, a potential weakening of rupee and a potential lowering of US interest rates, gold prices should remain supported, and hence one can allocate some amount of money in gold ETF or direct gold. In terms of real estate, it is all location specific. If you understand the market, if you figure out how the price movements will move, then it is worth looking at. From a rental yield point of view, our recommendation will be to be long commercial real estate, where rental yields are substantially higher than residential real estate.
All right, point taken. Thank you so much for joining us, and thank you so much for joining us actually on the NSE Prosperity Day, where we are helping our viewers, investors actually make the right kind of decision, the right kind of mix that is within the assets and of course on the time of duration and what you should really be including in your investment ideas there. But with that, let's slip into a quick break. But before you go, here are some sectors that big mutual fund houses are betting on for 2019.
The other segment where I find a lot of enthusiasm and excitement is in the consumer discretionary pack. Now, it's a pretty vast space, whether you look at autos or segments like jewelry, segments like organized retail, which has made a significant mark in the last 5 years, because this is not a very relevant sector on the overall profitability scheme. So autos, consumer discretionary, staples continues to remain very robust, but their valuations are a challenge. So these are 2-3 segments where I would be very keen. Where I am incrementally not very positive for last 1.5 years has been spaces like metals, spaces like pharma, which are yet to see any respite in the problems that they are facing on the margin and US business side.
Well, we are overweight on consumption in our funds, so that is a space which we like. Private sector banks as a whole, and not just the corporate lenders, are something which are going to do well this year. And we are, as I said, we are not only talking about the corporate lenders here, but we are talking about banks with good CASA, good retail franchise, as well as the pricing power, which is now returned. And you can see it in some of the results which have been announced that the NIMs have held on or marginally moved up, even for the larger banks.
Back, and you're watching the NSE Prosperity Day that we're celebrating on CNBC TV 18. Joining me now is Lakshmi Iyer, CIO, Debt and Head of Product at Kotak Mahindra AMC. Lakshmi, so where would you say that the best of performance really has been witnessed? Has it been more about the domestic or the global factors that need to be taken in account when you are investing?
So if you look at the returns of various asset classes through 2018 specifically, despite all these upheavals, fixed income was clearly still the outperformer amid two other categories, which is say equities and gold on a 12-month basis. And that was largely because globally, when there is a tendency for risk-off sentiment which happened towards the second half of the year, money tends to get out of risk assets like equities and try to find solace in say gold and or fixed income. And this is not globally. In India, what happened is that while gold ended negative on a dollar basis, because there was a rupee depreciation, gold actually ended positive for Indian investors on INR basis, but otherwise quite a few mixed responses overall. And with respect to participation, I think there was a fair bit of institutional participation which we saw, which kept the market a little bit afloat. And also once there was a little bit clarity that the credit scenario is improving, we saw the non-institutional, which is the HNI and the retail money coming back, but I would say in a much more slower manner than what it was at the first half of the year. The only wish and hope is that in the coming weeks and months, 2019 has begun on a reasonably better note, and we're just hoping that trend should continue.
Lakshmi, since you mentioned gold, and we have seen the prices gain up in the previous year, almost 8% in the Indian rupee terms, who are the investors and what is the best way of investing, and how much of allocation actually of your portfolio should be getting into gold?
See, if we all believe in the theory of mean reversion, gold has not really performed in the last 3, 4, 5, 6, 7, 8 years. As I said, last 1 year also, just because of dollar rupee depreciation, we were saved. So my sense is that there is that feeling of, and that too specifically because it's gold, because it's a very emotional appeal asset specifically for Indians. My sense is that there is a feeling of being shortchanged. And even though the outlook of gold might improve a little bit, we've seen initial green shoots last say 30 to 45 days have been reasonably okay for gold. I don't think it's too early for us to plot a trend saying that gold outlook looks fantastic, because as long as the economic recovery is reasonably okay, we don't need to be really galloping your way to recovery. As long as the global growth is slowing down a little bit but not falling off the cliff, the demand for risk assets will continue, and to that extent my sense is that gold will continue to play second fiddle with small spurts, of course. From a participation standpoint, I don't have any doubts in my mind that if one wants to own gold, it has to be the paper mode, which is the non-physical route, or the gold ETF route, which obviously buys physical gold on your behalf. So I think that is a much better way of participating rather than buying physical gold. I don't have any doubts in my mind.
And then, of course, it is about the debt and equity. There is also the long-term and the short-term debt is what the markets really seem to be liking. Is that the kind of mix that you also are advocating to the investors?
Sure. So I think to me, equities is like Red Bull. It energizes your portfolio. So as you rightly saw over the last 10 years, 15 years, make no mistake, equities have clearly outperformed fixed income. Fixed income is like Nimbu Pani. It just kind of, it does not charge you up, but it is required to give you a little bit of freshness, and even over near term, it renders some stability to your overall portfolio, which is why it is very natural that if you see the last 12 months, across market capitalizations, equity is negative. I'm talking about the broad indices, but bond or the fixed income category funds, probably all low category funds are in the positive. But as I mentioned to you, are we investing in equities for the next 3 months, 6 months, 12 months, or 18 months? Answer is no, because the underlying companies witness cycles, and these cycles are over a longer period of time. And therefore, remember, Red Bull, the moment you drink it, you don't start charging like a bull. That's not going to happen. It is to give you an overall, they're like carbs. Okay? You require the carbohydrates to give you the requisite energy for the body. So equity as carbohydrates to your financial portfolio, and fixed income is also required because you require the protein intake. So have a combination of carbs and proteins, both as a combination of your portfolio. And as I said, that is when you are having a wholesome diet. You cannot say that, oh, because I am high on weight or hugely overweight, I can avoid carbs. So I think a healthy mix of these two, there is no one size fits all, which is why I keep urging everyone that if you think you know it all, then please do it. If you do not know, please engage the services of a good quality advisor and help him or plan your way to prosperity.
Lakshmi, just taking that point home, as I said, it is going to be 2 budgets in this year. It's an election year. The markets are preparing for that. There's a change of guard at RBI that we've started 2019 with. So whatever investment policy decisions that you take today, would it be open for a change depending on how each of these events unfold going forward?
So 2 sets of questions, what you asked me. My sense is that yes, what are we looking from a policy perspective? A little bit of more certainty. We truly are one of the fastest growing nations in the world today. So there is an aspiration or a hope that there should be some sense of continuity. So there is certainty on one side which market wants. There is continuity of reforms and policy making from the policy decision makers on the other hand, which markets will look forward to. On your second part, will policy decision making really impact the portfolio? Again, my answer is a clear no, bold and underline. And why I say that is, as I mentioned to you, we have seen multiple crises in the last 2 decades. We've seen wars between countries. We've seen tariff wars, trade wars, we've seen oil crisis, you name the fiasco that could hit the globe. We've seen Lehman collapse, we've seen Southeast Asian collapse, we've seen multiple such things over the last 2.5 decades. But then the resilience of the economy is that it takes an interim break and then it moves along. So I think these policy decision making, or if there is an adverse policy, probably these things could, I would say, delay the progress, but not really completely derail you off from a growth path. So if that has been ascertained and that is very clear, I don't think you need to make multiple tweaks to your portfolios, because as I said, too many cooks spoil the broth. So if you try to bring about too many ingredients into your decision making of asset allocation, khichdi might taste good when you eat, but as I said, even too much of masala khichdi may not really hold good for your tummy. So I think stay the course, very, very important. Policies will come, policies will go. As I said, be patient and stay the course.
All right, Lakshmi, we'll let you go at that. Well, as our experts have told you, that yes, there are lots of events lined up, not just in India, but the international markets as well. But create a portfolio for a longer term. And no, there wouldn't be any policy changes that would need you to change your longer term discipline. Shorter term, of course, is going to be debt. Gold portfolio diversification is a must. And as Nilesh was pointing out earlier, real estate, go for the commercials. And that perhaps should be another thing that you should include in your investments. With that, that's all the time that we have on the show. Thank you for watching.